Greetings, accounting students. All right, so what we're going to do here is we're going to record a bunch of transactions that relate to inventory into our inventory card on the right, and we're going to use the FIFO assumption. So my students have access to these files. Anyone else, you're just going to have to get a bit creative, possibly take a screenshot and print it out so you can follow along. All right, so let's start on the left here. I'll just highlight this. So we've got an opening balance. We've got 10 units on hand purchased in May, and we've got 30 units on hand purchased in June. So in order to comply with the FIFO assumption, we need to record these in our inventory card and list the oldest ones first, the batch of 10 that we purchased in May at $8 each, and then underneath that we're going to record the 30 at $9. So in our inventory card here on the first row, let's just highlight how we do that. So the document, well, this is the only entry that ever goes into the inventory card that doesn't reference a source document. And the reason is because we would have managed that in the previous period when we bought and sold, etc. All of the rest are going to reference a source document, whether it be an invoice, EFT, a memo, etc. So as I said before, we need to list those 10 ones that we bought in May. They're our oldest ones, so think of them metaphorically in a pile, old ones. And then underneath that, we list our new ones so that we can follow the FIFO rule. Alrighty, let's move on to the second one on the third. So the owner has taken out 4 for personal use. So that's recorded via a memo. And so therefore, we don't know if the owner's taken out the $8 pile or the $9 pile. So therefore, we're going to use the FIFO assumption, first in, first out. So we assume that those 4 all come from the old pile, those $8 ones that we bought in May. So therefore, we're going to need to record that as an out for 4 units. And we're going to need to update our balances so that we're still reflecting the FIFO assumption. Okay, so document, that needs to be the source. That's our source document, a memo. We record it as an out because the inventory is leaving the entity. And we need to update our balance. We've still got those 30 in the new pile, 30 at 9, but 10 minus 4 gives us 6 more on hand for the old ones. All right, third transaction. This time we've sold 20 units. Now, this is where students get a bit stuck because of the value that's reported here, $20 each. That's the sale price. In the inventory card, we're concerned with the cost price effect. That sale price, given it's a credit sale, that will get recorded in the sales journal. So what we need to do to work out the cost price effect, because we're not told on that entry on the 6th, is we need to use FIFO. So again, let's have a look at our balance on hand here on the right. So 6 units on hand, that's from the old pile. They're going to go first. And then we're going to have to dip into the new pile. And we need to have 20 in our out column. So therefore, what we're going to do, let me just unhighlight this, is again, record your source doc. 6 from the out pile, 14 from the new pile. You need to work out your maths. 6 times 8 is 48. 14 times 9 is 126. So that pile from the $8, the old pile, they're gone. And now we're left with 30 minus 14 gives us 16 on hand for the newbies. All right, next one. Says here on the 8th that customer, Bunnings, that we sold to a couple of days earlier, has returned some damaged pots, and we're given a credit note. So if we go back to the 6th, we had some $8 ones and some $9 ones. So which ones are they returning? We don't know. So we need to use the FIFO assumption. And what we do with the FIFO assumption when we record an in from the sales return, because the inventory is coming back, it's literally the opposite of a sale, is we use FIFO in reverse. We're going to go with the last in, first back. And you might ask why. Scientifically, can't give you a good reason. It's a FIFO convention so that we're consistent from period to period. We're always following the same method. So those units are going to come back in. We're going to record that as a credit note as our source doc. So we're going back to that new pile. Again, when you ask why, that's just the FIFO convention that we go to the most recent out value when we have an in from a sales return. So we need to top up the balance. We had 16, 4 have come back. So now we've got 20 on hand at $9 each, gives us a 180 value. All right, we're nearly halfway through. On the 9th, we've purchased some new pots at $10 each. So what we're going to have to do is separate our two piles metaphorically. We've got that old pile of 20 units at $9 each sitting there. We're going to have to list them first, and then we're going to top up our balance with these 50 new items at $10 each. So let's have a look at what that looks like in our inventory card. Alrighty, so 50 in times 10 gives you a $500 value, and then we've topped up our balance reflecting the first in, first out, which will apply for upcoming transactions. Next one on the 11th. We've had a return. So therefore, we've returned some of those pots back to the supplier that we bought on the 9th. And this time we don't need to follow FIFO, because if we go back to the 9th, we purchased the 50 at $10. So we know for a fact that we paid $10 each for these. The GSTs are relevant. So therefore that's going to be an out, and therefore that's going to reduce the number of those $10 units we have on hand, but we still need to list those 20 old ones. So let's have a look at what that looks like in the inventory card. Again, make sure you identify your source document. So we support the verifiability QC, 5 at 10, and so we've updated our balance. Okay, now we're on the 15th. We've donated 10 pots. That's advertising. That's how you'd record it in the GJ, but I'll save that for a future clip. So again, we've done a bit of advertising. This is going to be an out. We've given up some of our inventory, and this is charity. But we're going to have to use the FIFO assumption here because we don't know if it's from the $9 pile or the $10 pile. So first in, first out, we dip into that old pile of the $9 units. We're not going to touch our newbies because we've got enough from that old pile. So let's have a look at what that looks like in our inventory card. All right, so 10 times 9 equals 90. So we had 20 of the old minus the 10 that we donated gives us 10 left, and we still list those 45 from the new pile. 3 to go. All right, then on the 19th we sold 40 units to Canterbury Nursery. Again, have a look at this transaction here in terms of the values. We're not going to use any of these. That $20 each is the sale price. That'll get recorded in the sales journal. We're not at the journal stage yet, so we don't need to worry about the GST. We need to work out the cost price effect when we're doing an inventory card. So again, FIFO comes into play here because we don't know if it's from the old pile or the new pile. So look at your balance here. We've got 10 old ones at $9 each. We're going to use all of those. And we're going to need to take out another 30 from the new pile of 10 so that we end up with those 40 pots sold. So let's have a look at what that looks like in our card. Alrighty, so again, let's look at our out column here. 10 at 9 from the old pile, 30 from the new pile of 10. If you total that up in the quantity, we've got 40 units, which matches up. with the number of units we've sold. Let's have a look at our balance. We had 10 at 9, they're gone. We had 45 at 10, we let go of 30 of them, so we're left with 15 at 10. Second last one, okay, we're a bit low on inventory, so we're topping up with a purchase of 25, and we've got a good deal here. There's $7 each. So again, in order to maintain the FIFO approach, we need to relist those 15 ones at 10. They're going to be our old ones, so we're going to list them first, and then we're going to top up our balance with those 25 newbies at $7 each. So let's have a look at what that looks like in the card. So again, it's an in of 25 units at $7 each. Oh, my maths is wrong there. Let's update that. That should be 175. Our balance is okay, so we've got 15 at 10 and 25 times 7. All right, now, then at the end, and this is usually going to happen at the end of a reporting period, we need to do a count of what inventory we have on hand in case we've had a loss or a gain. So we do our count, and our eyes say that we've got 42. So let's look at our balance here. If we go over to our balance in the quantity, we've got 40 units. So therefore, this is a good thing. We've had a gain. According to our records, we've got 40, we've done a count, we've got 42, so possibly we've undersupplied a customer or we've been oversupplied from a supplier. So which ones have we gained? Because we've got $8 ones right back here, we've got $9, we've got some $10 and $7 ones on hand. So how do we manage this? Well, we need to use the FIFO assumption. Now, or I should say FIFO convention. So what we do here is with a gain, a bit like what we did with that sales return, we go to the most recent in value, which was $7. So again, it's an assumption. And the reason why we use this assumption is so that we're consistent from one period to the next. So therefore, it's an in. We go to the most recent in value. On the 25th, we had an in at $7 units. So therefore, when we look at our balance column, we've got 15 and 27 in our quantity. Add those two up and you get 42. And again, we've listed that old pile of 15 at 10 and our new pile at 27 times 7.